be with you.
So, David, I figured we'd start with just a brief introduction of who you are and your background and such.
Sure. I run a consultancy here in Vancouver. I also operate a private mining company, which is acquiring and developing primarily gold and silver assets here in British Columbia. I moved into the precious metal space about 15 years ago. I had recently finished an MBA and was heading back into the aerospace world where I had come from previously as an engineer. I started to read Austrian school economics, and then started to put that together with the dot-com bubble, which had recently failed, and found it rather alarming in terms of understanding, I think correctly, that the world we live in is one that's fueled by debt, that it's unstable, and that it's on a path ultimately of terminal decline because of the structure of the monetary system. So in 2003, I started to move into the mining realm, and here we are today.
So I know before the interview we discussed a little bit about probably the biggest macro mover right now in eventual price discovery for gold. But let's begin, I suppose, with China, Russia, and Iran, and what is going on with the petro-yuan trade and gold flows to the east.
Sure. I think maybe we can start a little bit with the structure of the gold market, just because it impinges upon the gold flows and the petro-yuan. But the price that we see today is basically a digital price set by bidding for digital assets that are largely unbacked. The formation of the London market, the LBMA, was done in 1987 by the Bank of England, no less. 2 years after Larry Summers, and he afterward became the Secretary of the Treasury of the United States. But as an economist, he had written a paper that found that the relationship between the price of gold and real interest rates, it was a negative relationship. So as real interest rates fell, and the real interest rate is the interest rate minus inflation, so that's what you have left over. But as the real interest rate fell, that the price of gold would spike, and we saw that in the early 80s, where real interest rates end up surging to 9%, so 9% above the rate of inflation, up into the 19% area. And it appears what the Bank of England did was decided then, okay, well, we'll create a digital paper gold market, and that's what we have today in London, where more than 90% of the trading on a daily basis is just trading of these unallocated paper contracts between bullion banks. So back to your original question of what is going on with the flows to the east and the petro-yuan. China, I believe for several decades, has had a policy of developing the gold market. It appears to have started in 1979 with the creation of the Chinese Gold Army, and has really accelerated in the last few years. They are encouraging their citizens to buy physical gold and silver on the nightly news. And what they've done on March 26th is they introduced a petro-yuan oil contract in Shanghai. Now, it's very difficult to buy and sell oil with yuan because it's such a underutilized currency globally. It's only around 2% of the daily transactions occur with yuan. So what China has allowed is for these yuan to be converted into physical gold at the Shanghai Gold Exchange International Board, which permits from that free trade zone export of gold back to the oil producers. So why that's important is that the sheer size of the oil market is 20 times the size of the daily gold market in terms of daily production. So a relatively small amount of oil settling finally in gold payment can eat up a lot of the world's gold supply. And as a footnote, Russia for years now has been receiving gold bars in payment for its oil exports to China, and the oil exports this year are up 50%. So I expect the petro yuan / gold settlement is going to have a material impact on the New York and London digital markets, where they set a digital price for a digital gold asset, which is largely unbacked.
Yeah, and before we begin the interview, we discussed this a little bit, and we talked about the relation a little bit to today versus the old London gold pool, which was set up in the '60s to help to basically fix and keep the price as long as they could around $35 an ounce, and kind of climbed to 42, and then Nixon came in and did the Nixon shock because we had all these gold flows coming out of our official reserves here in the United States. So it's interesting to see some of the parallels going on, but this time it seems to be forming in the East. At least the probability that will be the actual mechanism that kind of brings the curtain down on the price containment mechanism that's ongoing.
Yeah, Russia is receiving gold for oil, and Iran has traded, 5 years ago was trading oil for gold to get around the sanctions at that time. And it appears that they may be going back to that again because of the reapplication of American sanctions this time. So just to give you a sense, Iran, they export about 2.5 million barrels a day. But if we use $1,400 gold and $80 oil, they would eat up, just for those 2 million barrels a day settling in gold, they would eat up 40% of the world's gold mine supply. And there are bigger exporters of oil than Iran out there. So Iran and Russia together, along with China, seem to be focused on resetting the global medium of exchange. I would call it that.
Mm-hmm. And I noticed that on your Twitter handle, you had covered a little bit about India recently buying 2.5 tons of gold. Any thoughts on that?
Well, yeah, India, I think, is the third or fourth largest importer of oil. They've got to have it. And that purchase of oil was in Q4 of 2017. Now, the discussion about the trading start this spring of the petro yuan / gold settlement contract was announced in September, and so in Q4 last year they bought 2.5 tons of gold with the central bank, and that was at around the same time that these discussions were happening in various articles on CNBC and Bloomberg, and Reuters was covering it as well. And it's interesting that oil has run from about $50 a barrel to $70 a barrel. Now, after that, at the same time that discussion was happening. So, I mean, there is a tight oil market in terms of physical supply, but there's also said to be what they call a risk premium, but it may be a transition premium in place because of the uncertainty that we're having here in terms of the future price of oil as well. So.
And of course, the inevitable question is when, right? I mean, obviously people have been aiming and hoping that gold and silver will eventually do the revaluation that the macroeconomy kind of asks for, especially with $237 trillion of debt recently updated, I think at the beginning of this year. So, the question of, who owes what to whom and who's going to go bankrupt eventually, and gold and silver resetting, I guess the big question in everyone's mind is exactly when this may occur. And I mean, is there any hunch that you have as to how this timeline might unfold?
I've been watching it for a long time now, and as you become intimately immersed in how the market functions, you realize how it's a fictional market, if I can call it that, or a fictional price. Mm-hmm. The price per ounce of gold. Yes, retail investors can go out and buy gold at that price, and you can get some through the London bullion market as well. But the reality is that the physical draw of petrogold is going to be so large that as it starts to engage at a greater and greater rate, what it does is it creates a price insensitive demand for gold. If you're receiving oil
Mm-hmm.
With Petrogold, you have to deliver gold back. So the question is, how much more can the physical market be stressed before the fictional digital markets, as I view them in New York and London, advertise their inability to deliver physical metal and fail.
Mm-hmm.
So, to directly answer it, it's uncertain, but I believe that the Petrogold trade is what is ultimately going to fail those markets, and we will have a price reset. And I'm anticipating a very, very large stepwise move in gold at that price. I don't see adding a zero to the price. It's not possible. The price that we have right now is one that's is not realistic in terms of the value of gold and the total debt in the world and the other assets in the world.
In terms of that reset end game, will it be market driven, or do you think it might be government, a meeting and they all of a sudden come up with some arbitrary number like they did in the 1930s?
Well, what would be helpful is an orderly transition and a restructuring of the monetary system. The debt-based fiat money system we have, where every unit of money is a unit of debt, is one that is offensive if you look at it on a rational basis of wanting stability and a objective measure, and also a unit of savings. So I'm hoping that it is a orderly restructuring, but who knows if it one day a suspension of trading in London and a disorderly move in interest rates, then we have a real problem. As opposed to a meeting, a coming to terms with the fact that we can't continue on the path that we're on.
Mm-hmm.
So the question is, if we try to militarily sue with violence, supporting a monetary system which is visibly failing, or if we accept the reality of where we're at and restructure with something much more stable.
Mm-hmm. I noticed that you talked about the LBMA being 90% of the volume of gold on a daily trade in the notional realm. But I'll share it with you after this. I'll email it to you. But I found in my research an academic study that was done from it looks like Australian professors and maybe someone from Ireland as well in the study. Yeah. But it's a study of who sets the price, COMEX or LBMA. And what the study essentially found was, yes, the LBMA has the highest notional trading, but the COMEX in the end actually has the largest influence over price discovery, which I found to be, non-intuitive, obviously, but when you dig in the details, it's pretty interesting what they found in their study. It was like a 17-year study, so.
Yeah, I'll have a look at it. I mean, the issue of the LBMA is it's the world's dominant physical market.
Correct. Yeah.
It's the platform on which like all the mining companies get their prices from the LBMA.
Right. Yeah.
So the digital price may be most greatly influenced by the COMEX, which is it's 0.04% of the contracts get settled there in physical metal, but the LBMA is the global dominant physical market through which the bullion is stored in London and the deliveries are through London or arranged through London. So as far as the metal itself, that is the world's dominant market.
Yeah, at least for now.
All right. Yeah.
I see in your Twitter handle you've done a lot of coverage as well of palladium markets, and there's not many analysts out there who are actually dig deep into palladium, so I wanted to get your thoughts on the current situation with that precious metal.
Yeah, it's auto sales in Europe and China are rising, and they're moving towards gasoline, and with gasoline engines, which are much more efficient than electric vehicles and much cleaner than the diesel vehicles. You use palladium in the catalytic converters. It's about 80% of the palladium market. Russia produces 40% of the world's palladium, and the other 40% from mine supply comes from the Southern African region. What we've seen is that the ex-CEO of Johnson Matthey noted that the major palladium stockpiles have been moved from Switzerland to the UK between 2009 and 2013, and that there's a physical stress there, a shortage of metal in the market. The lease rates, which to me are one of the indicators of availability of metal, pardon me, which can be relied upon. I don't use the price action to indicate availability of metal because these are all digital instruments. But the lease rate has moved into the last time I checked a few weeks ago, it was running about 8%. And it has risen from 0 and a negative rate when palladium is highly available. So I think that the metals market is being stressed. The palladium market is being stressed. The question is that do auto sales decline from a precipitous economic decline before there's a failure to deliver, or do these prices and the shortages manifest themselves in terms of a palladium market disruption?
Mm-hmm. So, I believe palladium, it had a disruption, right? In, was it 2001?
In the late 90s and early 2000s, I think the 3-month lease rate went to a 300% annualized rate in London. That's how short of the metal that they were. And the Russians had an estimated 25 million ounces that they stepped in with at that time and saved the London paper market. So those stockpiles are gone, and the London stockpiles are a fraction of what they were. So, it's really a balance, fine balance right now in terms of the flows of the physical metal into the market. But if there's a disruption in supply in London, you'll see extraordinary prices for palladium because the automakers have to have pollution control devices on their cars when they're shipping them, and shipping an auto plant run over $5-10 million a day in terms of the large plants. Disruption to the supply chain. So that's the last thing they want to see.
Is there any threat of thrifting for using platinum instead of palladium? Is that a possibility?
They can. They are substitutes. The challenge there is that there's switching costs, and the melting point is of the order of 400 or 500 degrees difference of platinum and palladium. So they're not direct substitutes. You have to modify your equipment to accept platinum versus palladium, but they are a substitute. The low price for platinum and palladium for decades now, though, has resulted in a world production structure, especially in Africa. Many of the platinum palladium mines are losing money on a cash basis. They are not structured to increase their production quickly, and there's not a great surplus of that metal.
Now, I've heard in prior interviews of yours that you mentioned your disdain for watching the day-to-day prices for precious metals set mostly by the LBMA and COMEX. What advice out there would you have for those precious metal holders who feel beaten down, the ones who are perhaps losing hope in their precious metal holdings?
Yeah, well, I can't give advice. I'm not a licensed financial advisor, but personally, I find it useful just to ignore the price action. We can see the malstructuring of the markets as helpful out there. I view the metals as an insurance policy, not a day-to-day investment. And I think that that is helpful for me to say that I'm in this market because of the ultimate consequences of 100 years now of a messed up monetary system. So I take a longer view, and I don't view the day-to-day price action of as having any meaning in terms of the value or the supply and demand for the metal. It's digital trading on digital exchanges, which are dominated by New York and London. But the real offtake that we're seeing, and by the way, this year China so far has delivered about 70% of the world gold mine supply out of the Shanghai Gold Exchange. By the way, that does not include, is not believed to include Chinese government purchases. So we can see massive pull in the physical metal over in China, but yet the price is if it's indifferent to the stress that's being put on the market. So one point it will fail, and I think it's essential for people to understand the value of these assets as financial lifeboats.
And one final question, just along the lines of China allowed over the last decade to import I don't know 15,000 tons of gold or whatever it's been. Do you think that there's been a tacit agreement between them and America? I know Tim Geithner went over there in 2009, and that seems to be kind of when this really started to take off in terms of China taking physical imports.
It's really difficult to tell, James. That the best that I can see, looking back through the writings that have gone out over the decades, is that China decided, I believe, in the late 70s to embark on this path, ultimately of modernization and of structuring its monetary system. Paul Volcker drove the American effort to get America off of the gold standard. He said in an NBER interview that he was the primary coordinator and promoter of that. Mm-hmm. And I think at that time that China, they operate with a very, very long-term view of things. And so I think that this has been going on for a very long time. I do not know what happened with Geithner and the Chinese, but I think what we're seeing now is the end game of a very long-term plan to establish themselves as a dominant global force.